This is the third part of the presentation on the U.S. debt crisis. My name is Pat Obi, Professor of Finance at Purdue University, Calumet. In this segment, we talk about how the financial markets responded to the downgrading of U.S. credit rating by Standard & Poor's, and that's the big embarrassment that caused a lot of uproar, anguish, and sadness in the international financial markets. And that happened on Friday, August 5th. All right, so they downgraded U.S. credit rating from AAA to AA+. Now, though, understand that when you lower the credit rating of a firm or government, you're saying that that borrower is now higher credit risk. In other words, the odds of losing money if you were to lend to that individual, or in this case government, have gone up. Also, with that, you can expect higher interest rates on U.S. government bonds, which we call treasury bonds. But look over here. On the first trading day after Standard & Poor's downgraded U.S. Credit rating, that first trading day being on August 8th, 2011, the benchmark long-term interest rates on U.S. government bonds actually fell from 2.56% to 2.34%. So you can see it right here. And generally, actually, current interest rate levels in America on government borrowing is pretty much the lowest that they have ever been for as many years as anybody can think of. So this is like a contradiction in terms. Well, someone could argue and say, well, the reason interest rates fell is not really because the financial markets were oblivious of the downgrading of U.S. credit rating, that it's because the weakness in the global economy caused many to simply buy U.S. Treasury bonds since there were nothing better, nowhere better for them to put their money. Well, that sounds like a plausible argument, except that over here, what I did was to compare interest rate on U.S. government bonds right from the day that the credit rating was downgraded to the average interest rate on AAA borrowers, all right, AAA government, corporate bonds. So you can actually see here that, for example, on the first trading day, the average yield on U.S. Treasury bonds was 2.34%. On the other hand, bonds that supposedly have higher credit rating were actually selling to carry a much higher yield of 2.53%. So basically, what you're seeing here over the days that followed is that U.S. government rated AA+ by Standard & Poor's was still able and has been able to borrow at a much lower interest rate than borrowers rated AAA. So I think that the evidence on the ground does not back up the sentiments or opinion of Standard & Poor's. Now, though, according to Standard & Poor's, the UK, France, Germany, Canada, and Australia all have AAA credit rating. And if you compare the interest rate on U.S. government bond on this trading day, you find that it is still lower than what Great Britain is able to borrow at, 2.53% on 10-year bonds, which is the yield that is referred to right here. 10 years is the benchmark long-term period for U.S. government borrowing. Now look over here for German bonds. Again, 2.33, higher than that of the U.S. Look over here, Australia government bonds, 4.43, higher than that of the U.S. In fact, Japan, which also has only a 2A+ rating from Standard & Poor's, has the lowest, 1.05. Then again, we need to be aware that in Japan, the vast majority of Japanese bonds are actually held domestically within Japan. All right. Nevertheless, this is noteworthy. All right. Now, though, finally observe that actually, much as there is a lot of hue and cry regarding the U.S. Credit crisis, or debt crisis, actually, that we're actually not much worse. In fact, not really worse than most of the countries. Japan, of course, is the worst because its debt to GDP ratio is a whopping 204% in 2011. It's actually the worst. No one talks about it, but Japan does have internal strength. So don't mess around with Japan. Their unemployment rate is only about 5%. Inflation is very low, about 1.5%. And although the economy hasn't quite done all too robustly in recent years, but the country holds itself and holds its own. All right. Now you have to worry about Greece, which everybody's worrying about right now. Look at that, 130%, because Greece doesn't have the taxation power that Japan or the U.S. Has. Italy is also mired in huge debt crisis right now. But look over here. US, okay, about 100%. But look at France, though. AAA is about the same. Look at, well, Portugal. We know that Portugal does have its problems, like Greece, But the other major powers in Europe, look at UK, 94%, and even Germany, okay, it's a little better, but not much better. So if you compare the US to all these other strong countries, in Europe, you find that really that there is no significant difference in terms of our debt situations. And therefore, while we are extensively discussing issues concerning the U.S. debt crisis, we cannot ignore the kind of dicey situation in Europe and elsewhere.